Hello, thank you for joining. My name is Alejandro Delgado, Technical Manager of AleaSoft, and I welcome you to the third part of the webinar, Influence of Coronavirus on the Electricity Demand and the European Electricity Markets. As you can see, the speakers today will be Oriol Saltó, Data Analysis and Modeling Director of AleaSoft, Pablo Otín, CEO and co-founder of Powertis, and Miguel Ángel Amores, Manager of Renewable Energy of Triodos Bank. Please use the Q&A menu to send us any questions you have, and we will answer them after the presentations. If you want to address one speaker directly, please include his name in your question. Oriol, you can start now your presentation. Please share your slides.
Good morning. Thank you, Alejandro. Let me share. Okay, I hope you all can see my slides. I'll start right away because I have a lot of information and I want to be on time. So, okay. So as I said, I have a lot of information. Afterwards, you can ask for the recording of the session, so you can stop at your preferred slide and look carefully at the data. I will just go ahead, talk about a bit about our company. Our company offers forecasting services for the energy sector for all the European markets. We basically forecast any variable that can be needed for any company in the European energy sector. Our methodology is based in Alea model. It's a statistical based model, and it's a hybrid model that uses statistical classic techniques like regression, econometrics, time series analysis, and also artificial intelligence through using machine learning algorithms and artificial neural networks. The strength of our forecasting techniques, what we always stress, it's that it's based on a scientific methodology. It's robust. It keeps consistency over time, and well, we have been using it for more than 20 years. We started in the Iberian electricity market, and now we are covering all the European energy markets. So, about the pandemics right now in Europe, most of the countries are already de-escalating all the measures that they take in order to stop or contain the propagation of the pandemics. So right now we are going back to what's called the new normality. We have seen that heat and solar radiation, ultraviolet radiation, somehow affects the virus. It makes it less probable to expand, but the virus is still there. Heat will not make it disappear for complete. Right now it is it's less violent. So we are keeping the death, the casualties, the number of casualties low. Also, the propagation is slowing down. But the uncertainty right now, it's at the beginning of the winter. Low temperatures are favorable for the virus in order to expand again. Probably opening of schools and universities can create new outbreaks. So uncertainty is right now at the beginning of the winter. This can impact energy demand and obviously also energy markets. So let's look at the evolution of the commodities and CO2 emission rights. We start with oil. Brent oil numbers for 2020 up to year to date. We are at the level of the $40 per barrel. Are the lowest values that we have been seeing in the last 15-20 years. But what we are clearly seeing is that the price is already recovering. We hit the rock bottom at the 7 or 8 weeks ago. In the last webinar, we were talking about, well, we are seeing signs of recovery. Right now, we can say that price is clearly recovering. In the case of the gas prices, at least what we can say is that price already stopped falling. It's a situation that it's coming from the last quarter of 2018. So it's been a lot of months with that clear downwards trend. Right now, prices hit at rock bottom below around 4 euros per megawatt hour, and we are seeing some kind of recovery signs. In the case of CO2 emission rights, what we saw this panic drop in the mid-March when the pandemic arrived in Europe. It recovered very fast, but again, right now we are already at the levels of previous to the crisis. In electricity markets, I will not go through all the through all the markets. You can follow the evolution in our observatory. You can find it in our website. We have all the European markets. The last one that we added is the Romanian market. We also added graphs for the evolution of oil, gas, and CO2 emission rights. As a summary, you can see here how the electricity demand varied from this year 2020 versus last year 2019. Interesting things to see is that already in February, where the pandemic was not here yet, we were already seeing lower values than 2019. This was mainly due to weather conditions. Winter conditions in 2019 were quite severe. This year, the winter was smoother, temperatures were higher, so that had an important impact in the electricity demand. So we were already, at the beginning of the year, we were already having lower demands. Then pandemic arrived. The lowest levels of demand in most of the countries were reached in April, and then we started the recovery. June values are the first half of June, obviously, and we see that in most of the countries, demand levels are recovering, but obviously we are still far from the values in last year, in 2019. In the price variations, again, against last year, we also see that already in February, at the beginning of the year, we were seeing prices that were at least 30% lower than the last year. This was due to the downward trend that we had since the last part of 2018 due to the decreasing gas prices. So at the beginning of the year, we were already having much lower prices than in 2019. Then the pandemic arrived. Prices kept falling at a higher rate. And then in May, June, depending on the market, we are seeing how prices are recovering. Obviously, still very far from the levels of the previous year. What about the futures market? Brent oil futures hit rock bottom around by the end of April, the beginning of May. And right now, as prices are recovering, we are already seeing futures prices for the next month, next year, around $45. And at the long term, we see how the price did not change much during this crisis, and we are seeing prices at the long term around $55 per barrel, as we were seeing during all these crises. For gas futures, we are seeing similar situations. The lowest prices were reached at the beginning of June, and right now we are seeing how future prices are begin to recover. And again, in around 2024, we are already seeing the same prices that we had before. Equilibrium prices around 15 euros per megawatt. In the case of electricity futures, already in previous webinars, we have seen how the prices drop really fast in mid-March when the pandemic arrived in Europe. Then we had a recovery, and then the downward trend that we were already having before the crisis. kept the prices going down. Right now, prices has clearly stabilized, and we are already seeing some kind of recovery, basically because gas prices and CO2 prices are already increasing. So this rises has an impact in the electricity futures, where we are start seeing recovery, as we have seen in the case of the spot prices. And now looking at the future, International Monetary Fund just yesterday published a new update on their World Economic Outlook. Right now, for the European Union, the forecast are a decrease in the economy around 10%. Previous forecast by the OECD were more or less at the same level, depending if we will have a new outbreak in winter or not. It's interesting to see how in this scenario, where the OECD forecasts, in the case of a new outbreak in September, October, and November, then this will have an impact obviously in the economy in 2020, but a most important impact in the economy in 2021, where increases can be as low as 3.5%. In the case of Spain, Bank of Spain had 3 scenarios at the beginning of the second week of June, had 3 scenarios. The first one is already highly improbable. The most probable scenarios are around 12%, 14%, 15% in the case of new outbreaks of the pandemic. OECD are already at this level, close to 15% in the case of a new outbreak. And the forecast from International Monetary Fund just from yesterday, again at the same levels, around 12, 13% of drop in the GDP for this year. Looking how or seeing how can this decrease in the economy can impact the electricity demand in Spain. These are the forecasts that we have made, not with the with the GDP scenario from yesterday, but from the last week. The decrease in 2020, it's quite, right now we are almost at half of the year, so we are seeing around our central forecast is around 7.5%. But in 2021, depending on how the economy evolve, the central forecast is around 4.5% increase, but it can be as low as 3% in case of new outbreaks or a very slow recovery of the economy. And when forecasting power markets right now, what we are seeing is that gas prices are showing signs of recovery. Oil prices are clearly recovering. So electricity markets are also showing, well, not strong, but it's showing a consistent increase in prices. It is due obviously to the increase in gas prices, but also it has a seasonal component due to the increase of the demand of electricity with higher temperatures and decrease in wind production and hydro production during the summer. So for the summer, prices and forecast look quite stable. We will be at lower levels as from last year, but the forecast is somehow stable. Now the uncertainty is put on the beginning of the winter. New outbreaks of the COVID can create much uncertainty on the recovering of the economy. This will impact in the recovery of the energy demand, and it will also impact on electricity markets. At the longer term, our models are shown that the market equilibrium did not change much. It is still at the same level as before. Uncertainty is in the midterm, where we do not have still a remedy for the COVID, but sooner or later a vaccine will appear. So at the longer term, we are seeing more or less stable forecast around the same equilibrium market that we were seeing before. As always, our recommendation in order to protect yourself against this market price fluctuation, or protect yourself or take advantage of it if you are buying energy, always have an energy purchasing strategy based on reliable market vision of the future. And just summarizing what we have said, energy demand is recovering, power market prices are also recovering, thanks to the recovery of gas prices and oil prices. Uncertainty is right now at the beginning of the winter. And although although new pandemic will have less impact in the health crisis because we already have all the experience, but it will for sure, it would delay the recovery of the economic crisis. At the long term, things didn't change much. And again, our recommendation is having a robust strategy when buying and selling energy. And just to finish it, let me invite you to our next webinar. It will be after the summer, so we will be hopefully in the middle of the recovery, and we will see things clearer, at least for the next winter. And thank you very much.
Thank you very much, Oriol. Pablo, when you're ready, please, you can share your slides and start with your presentation.
Sure. So let me share, well, first and foremost, thanks to AleaSoft for inviting me. And I'm gonna start my presentation right away. Just wanna confirm that you can see Powertis first slide.
Yes, we can see fine, thank you.
Very good. So a brief intro first on myself. I'm Pablo Tim, I'm the co-founder and CEO of Powertis. Been in industry for about 18 years in wind and solar, and operate in many countries, both sides of the Atlantic, USA and Latin Americas, as well as Spain, Italy, UK, and a little bit of experience over in the Southeast. Run operations both on the development side, equipment supply, and M&A. And for the last 2 years running Powertis, which we are a developer. We operate in 3 markets, Spain, Brazil, and Italy. And we have a very clear mandate, which is develop large-scale PV utility plants. Within that scope, our aim is to do projects what we call ready to invest. This is a new terminology. What we're trying to capture under that concept is that we go through the whole process of getting a project up and running and in operation, which certainly has significant impact on what's happening today with the markets, because as part of our offering is to deliver PPAs. So currently we have signed a little bit over 1 gigawatt of PPAs. Our pipeline is significantly larger than that. It counts today at around 6 gigawatt. And as you can see from our footprint, we're basically focusing in 3 markets: Spain, Italy, and Brazil. And for the scope of today's discussion, we're going to be focusing mostly on Spain and Italy. It's important to say that we're part of a much larger group that includes a very important company in the solar universe, in the solar ecosystem, which is Soltec, the 3rd largest tracker supplier in the world. Soltec has a significant market share in the key markets globally. Number 1 in Brazil, number 3 in Spain, and number 3 globally. And as you can see, we work with the top tier client, and we have a top tier clientele in our company. And Soltec provides the trackers for Powertis as well as the construction of our projects. So after that kind of overview of what we do and who we are, I'm going to be focusing on one slide and one slide only, and hopefully I should be able to dissect our view of the market today and what has happened over the last weeks and months. I'm going to be comparing past, sort of this near past, with sort of call it today, and what we could see in the future. And I'm going to be using the information that you can access freely on AleaSoft website, that you can see on the right side of the screen. And that is based as of Monday this week. So that was the 22nd of June. So, and that's sort of the whole idea. And the idea as a developer is to understand whether the market has reached what we call equilibrium. Basically, what we're seeing today is what we can anticipate in the future, what is now being, we're using this new term of new normal, this, interesting concept about what's gonna come in the coming months and weeks. So, and to kind of have that idea of the changes, I'm gonna be focusing on the worst time, point in time in the last months, which was, in our view, March. And I think from Ariel's previous presentation, I think we can all agree that that was sort of the worst times if you want to see what happened. So markets went through a significant down spiral in March, and now we're asking ourselves whether we have reached the equilibrium in the new normal, right? And we see, with that comes the first thing I want to note is that the new normal obviously is being accelerated by the very unfortunate events of the pandemic. By the way, our thoughts and praise goes to everyone affected by these horrible events. But with that, we need to say that things started much earlier, right? Things started at the very least in September last year, and if you look now on the slide in the section that I just highlighted, we're showing that for most of Europe, and certainly for Italy, it started in September last year, but it's been affected by a downward spiral since, obviously peaking in March. So we need to accept the reality that we passed the time in which we have the highest peak on energy, instant demand, generation. That is all behind us, and we're going to see a new normal, which would be lower. The question is how lower. And then to give a sense about how affected we see the impacts of the coronavirus in our daily lives, we took the example, what we call a rear view analysis of Spain. So in March 2020, demand reduces by 6.3%. That's compared with the previous 10 weeks. Generation from renewables happen to be very high. We have a lot of wind, in particular in Spain, 21%. But generation fleet has grown 27% already since the peak. So the more wind is nothing new. We have seen more wind, and we're going to see much more renewables coming into the market. We saw a thermal gap. There's basically the difference between generations from generation that beats a zero cost, basically that as available, that reduced significantly to the point that has to reduce the energy produced by the nuclear fleet, in Spain, the nuclear power plants. And as we saw in previous slide, we saw significant reduction in gas, coal, and CO2 pricing, some of the lowest in decades, some of which is still very low. So resulting in prices dropping by 32% in March 2020 when compared with 2019. Average weekly prices fluctuated in the range of 20 to 35 euros per megawatt hour during the period of, we'll call it the key period of the pandemic, March 2nd to April 5th. And the average pricing in the Spanish market reduced to 27 euros megawatt hour, almost 28, which was about 40% below what we have seen. So first question we have is, how does it compare? Now we look at the right part of the slide. When we see what we have this week and the last 3 weeks, how does it compare this week with the previous years? Well, first thing is, as you can see in the new dotted line on the daily data for Spain, the curve today is about 125 gigawatt hours lower. So we have a 10% reduction in demand. The shape is relatively similar, but we have at least a 10% reduction in demand of what it was the average week last year in June. Then pricing. So if we take the pandemia's sort of range, which was between 20 on average, between 20 and 35 euros per megawatt hour, and we see the pricing of the last 3 weeks that confinement has stopped, mostly in Spain, and we're getting back to the new normal, you can see that the pricing fluctuation is well within the range. So it looks like we're sort of, the market has stabilized in that, in that bracket, if I'm going to call it that envelope. So we see a relatively smaller spread in pricing. And if we compare what was the average pricing in March, what we're seeing today, you can see that we're right in the middle. So there's a consistency pattern that shows that we're, kind of in an equilibrium position today in the markets. Same with the profile, low profile. They have, they're very narrow. They're following each other quite closely. So it's fair to say that what we have now in Spain is likely to be what we're going to see in the coming months. We wanted to look at a second example. We look at Italy to see exactly sort of the same ratios and get a sense about what is today's new normal versus what it was last year. Italy is a little bit more dramatic, as you can see today. When we compare the energy, daily demand with same week last year, June 2019, the reduction is much more significant. Italy, when daily demand went up to 1,200 gigawatt hours per day. Today, they're not reaching 900 gigawatt hours. So Italy is losing on a peak basis 300 gigawatt hours, which is almost 30%. I just highlight as well that there's a little glitch when you look at the daily data demand for Italy, is because on June 2nd, it was a bank holiday, and you can see there's a significant drop in demand. So it's just highlight to make sure that there's clear understanding that otherwise it would be, it would follow similar pattern. And then looking at pricing in Italy, it has moved in March 2020 between 33 and 20 euros. It's slightly, pretty much similar to Spain, so sort of the same bracket, it's slightly lower peak. And when we compare what we're seeing today in Italy, clearly we're as well in the same bracket. So Italy is moving on a pricing basis, a similar pattern that we're seeing in Spain, as well as what we saw in the midst of the pandemic. And funny enough, the only difference would be that the average price in March, 32 euros megawatt hour, is much higher than we're seeing today. So it looks like Italy still not yet have achieved the equilibrium, while we clearly saw that in Spain. And then when we look at the curves, the profile is very similar. So basically, overall, we can sort of come to the conclusion that both markets are kind of achieving the equilibrium point. So that's a sort of an overview of everything that I tried to unpack in this slide. And the conclusions from our standpoint of view are 3. The first is that for a developer, it looks like right now we have achieved a point that there is some sort of basis to start building, some forecasts and some projections. And now we can freely say that the turbulence are something more of the past than of the future. And now we can sit down on the table and start discussing negotiating PPAs in the long term. The second conclusion that we see from Powertis standpoint of view is that until we have a much larger demand that comes from electrification, electric cars or else, what we've seen today in Europe, certainly for Spain and Italy, is likely what we're going to get in the near future. So when you might recall from the graphs that we just went through that the peaks are lower, the curves are flatter. There's not the biggest spread that we had before. And the price, and in some cases, not in Spain or in Portugal, we're going to see negative pricing, particularly over the weekends. That has become the new norm in a number of markets where they have that scheme to sort of resolve pricing mechanism. And the third is that the current pricing levels, and then we look at the energy fleet, carbon and nuclear, in our view, they're going to have a very, very hard time to survive. Just simply their pricing doesn't match their costs. It's, maybe there's a need for it, and there has to be some sort of structures and subsidies to keep them up, particularly nuclear as a CO2-free technology. But today they're out of market. And in our opinion, gas, they're surviving, and they're able to get to clear pricing because of the gas price are very, very low. If we look at about minus 45% of what it was before, but we think that this is a glitch, and as the economy stabilizes and starts to consume gas, that it will change, likely to go up, and they will have a hard time. Not today, but we'll have to see what happens towards the mid and end of the decade. And finally, our last view is that wind as well will have to evolve much faster than right now, because solar is becoming a killer solution, which significant price improvement and technology improvement that make them the natural option for growing, for going carbon free. And with that, we sort of close our view what happened in Europe in the last month, and and clearly our commitment is to continue growing our portfolio in Spain and Italy, and we think that we are likely and lucky to have the technology of the future that today is competitive and very likely to be even more competitive as the new solar solutions comes to the market.
Thank you very much, Pablo, for your presentation. And now, Miguel Angel, if you're ready, please share your slides.
Okay, thank you very much. Give me 1 second, please. Yes. I think that you can see the presentation. So first of all, thank you very much to AleaSoft for this kind invitation to Triodos Bank. First of all, I want to make a short introduction to Triodos Bank. For those who don't know about Triodos Bank, we are a European bank with office in some of the Western Europe countries as the Netherlands, Belgium, United Kingdom, Spain, and Germany. Triodos Bank was created in the 80s, so we have more than 50 years of experience in a different way of do banking. So the purpose of Triodos is to create awareness about the importance of the money, to create and promote sustainable development, and to push other banks to be more sustainable and transparent. So as an example, we finance in 3 different sectors: the environmental sector, cultural and social sector. Some examples, we finance theaters, films, education, schools. And on the environmental side, we finance not only renewable energy, but also energy efficiency, organic food, organic farming, etc. So we have now in Europe more than 700,000 clients in these countries. And regarding renewable energy, we have financed around 1.6 billion euros in different renewable energy assets as a bank. But also we have an investment fund, and with this investment fund, we have invested around 1 billion euros in different renewable energy plants around the world. The total number of projects on the renewable energy side is around 500 projects. Most of them are wind farms and PV plants, but also we have financed some small hydropower plants and different installations about biomass, cold storage, and energy efficiency. Total power of these plants are 4 gigawatts. And that means a reduction around 1 million CO2 billion tons of avoided emissions per year. According to the Clean Energy Pipeline Global League, we are a leader as a bank in the number of deals that we have financed as project finance in the renewable energy world. Of course, this is regarding a number of deals because we are in size lower bank than other big banks, of course, and the average size of our loans is lower than other banks. And regarding what are the typical structure we offer for new renewable energy assets, you have here a table that summarizes the main financing terms. We have divided here 2 different options. If we have a PPA or we have merchant risk. Tenor in both cases is around between 15 to 16 years. Obviously, it depends on the risk profile of the project. Could be a little bit lower or could be a little bit higher. The average size is that. And it depends also on the technology. With PV plants, we have more room to extend the term. For wind, its maximum tenor is 16 years. Regarding the debt service coverage ratio, if we have a good PPA, we get a structure finance of PV plants with at least 1.35 of DSCR. For wind farms with good PPA, typically DCR is 1.40, but of course, since this depends a lot in the project, it depends a lot in the PPA and the off-taker. With merchant risk, the typical ratios are 1.40 for PP and at least 1.50 for wind. We consider P50 for PV plants in the depth sizing production and P90 for wind. We typically introduce some cash sweep in the projects in order to increase the leverage, but it's something that depends on the needs of the sponsor and on the risk profile of the project. Typical range is between 0 to 35%. And that means that the leverage that we have seen in different projects that we have financed and when we have offered different term sheets is for PPA between 55% and 70%. And for merchant risk nowadays is between 40 and 55%. I insist that it's the usual range, but it could be very different depending on CapEx, OpEx, and yield of the project. Other important elements to be considered is for PPA, of course, we prefer off-taker investment rate, but we can finance also if we have off-taker non-investment grade. In that case, we require a bank guarantee in case of early termination of the PPA. And to consider this general framework for finance PPA, the PPA should have at least a tenure of 10 years. And other important remark for merchant risk is if it's possible to do cross-collateral with feed-in tariff plans. It's something that works very well in order to increase a lot the leverage that we have seen in this table. It's something that we have done with some clients that has a portfolio with PP plans with feed-in tariff, because the regulatory life of PP plans are more or less the tenor that we demand for merchant risk. So that's fit very well. And in that cases, what we have done is get the depth of the plan with feed-in tariff, offer new finance, typically increase the leverage of this asset, and at the same time increase a lot the leverage of the merchant risk project. So if it's something manageable for a sponsor, it's really, really recommendable for them and for us to decrease the risk of the project. Please note that we have a long track record in financing renewable energy assets. I haven't explained before, but we first project that we financed in Europe was a wind farm at the end of the 80s in the Netherlands after the Chernobyl disasters, as a way to show that there was another way to generate energy, and that in that time, more than 30 years ago, there were, it seems, crazy people. That now it's obviously the present and the future of the renewable of the energy world. So we have a strong track record in financing renewable energy. We are more than 50 people in Western Europe, in different countries, financing renewable energy assets. So we've financed a lot of feed-in tariff plants, but also in Spain we have financed some plants under auction regime of 2017. We have financed plants with PPA, some with merchant risk. First wind farm that we financed with merchant risk was in 2016, so more than 4 years ago. And we have financed other assets with merchant risk. So we have experience. Of course, because of the size of the bank, we are conservative. So because it's a way to protect the bank, but we are, I think, very creative. And we also finance self-consumption with different tools. We can also offer project finance for self-consumption. Especially, we have a portfolio with different off-takers and a minimum size of 2 million euros of debt. And we have finance also under project finance district heating. Good example is district heating in the city of Soria in the north of Spain. So I think we are very creative and flexible. In our team, one of the differences with all the commercial banks is most of us, we are engineers. Some of us came from the technical advisory, so we are very familiar with the technology to offer flexible ways to finance. Ticket size is something that we have not mentioned in detail. So minimum size for project finance is 2 million. So it's obviously, I think we are the only one, at least in Spain, that we can offer project finance for this low range. Of course, for us, it's much lower profitability, but it's part of the mission of Triodos Bank. And a maximum ticket size is 25 million per borrower. I insist it depends on the risk profile of the project. If it's a merchant risk, probably depending on the leverage, we can get this 25 million, but probably if it's a medium risk, probably we will prefer up to 15 million euros. And that's and regarding the COVID impact, what we have seen, what is our feeling, our perception of the market. So as a general view, I think that the market, at least in Spain, is really active in spite of the decrease in pool price. Main reason is that I think both the sponsor and financial entities see what is the long-term perspective, and the long-term perspective is good enough to invest and finance in renewable assets. Of course, there are some important uncertainties. One is the recovery in the short terms, and second is in the capture price, especially for PV plants, at least in Spain, in the long term. So it's something that we should manage, and that is the reason why the leverage for merchant risk is low. And of course, when we talk with all the banks and with all the sponsors, the general perception is that this market is very active, even in the current circumstances, because this sector is less affected than others because of the COVID crisis. So it's feel that it's safer than other sectors. Of course, from the investor side, there's different kind of impacts on because of the COVID crisis. If you are in the promotion phase, good news is for you, maybe you have the opportunity to negotiate the price in some cases, and other not. But there is in some cases there is a window of opportunity for do that. Your project under construction, of course, there are potential delays in supplies and construction, but it's at least in the portfolio that we have financed, we haven't seen a strong impact in these delays. But of course, there are potential delays in some months. And project in operation, and what we have seen in our portfolio, as is obvious, high impact is plants under auction regime of 2017 and plants under merchant risk. For different reasons, in our case, plants more affected is those with auction regime than merchant risks, for different reasons. For plants with PPA, the impact of this crisis is medium, depending, of course, on the coverage of the PPA and the kind of PPA that they have. But it's something, at least from the lender side, very manageable. And for plants with feed-in tariff, the impact is really low. Note that probably the incomes that depends on pool price is around 10%, 15%. So the impact is low, and in any case, theoretically, every 3 years, the economic regime will be updated and compensating this drop in price. And from our lender side, what's the real impact of this crisis? So of course, we have updated our price scenarios. That means a decrease in the leverage. There is, of course, an uncertainty in the short and medium term. So that means that we have a strong preference for PPA with off-taker investment grade than other options as merchant risk or weak off-takers with PPA, and has increased a little bit the price of the financing. And from my side, that's all. Thank you very much for your attention.
Thank you very much, Miguel Angel. We will start now the Q&A section of this webinar. We will try to answer as many questions as possible in the time we have left. I believe Uriol has already a question. Uriol?
Yes, thank you, Alejandro. The question is, International Monetary Fund decreased expectations for Spain by 5 points in their last update. How is this impacting in your Spanish demand forecast? Well, the forecast from International Monetary Fund is a little bit lower than central forecast from Bank of Spain and OECD, the ones that we were using. But still, the lower scenarios from Bank of Spain and OECD, the lowest scenario were already covering that a little lower scenario from International Monetary Fund. So the forecast that that we showed for the Spanish demand, the band that we had covering different scenarios from economic recovery were already including or covering this new scenario from International Monetary Fund. So the forecast that we showed, it's still valid with these new scenarios.
Thank you, Uriol. Pablo, do you have a question?
Yes, so I'm going to answer the first question from Antonio Bacaro. I hope I'm saying your last name correctly. Are companies like Powertis also considering storage facilities like hydrogen or otherwise? And the simple answer, short answer is yes. Now let me elaborate a little bit more. So the truth of the matter is that there's two key words, two fancy words that developers are using today almost on a constantly basis. One is storage, call it batteries, and the other one is hydrogen. And I think that's sort of the right approach to it. Right now, where developers thinking how we can make as available solutions, wind and solar, to a firm product. And it's natural that we're gonna go first through storage dash batteries. And I'm using the word batteries on a broad scope because it's likely to be many forms, not only just in the call it Tesla basis, right? Lithium ion. So that's likely to become the norm between now and 2025. It's interesting as well that the government, particularly in Spain, just announced a new decree yesterday that getting forced today, that for the first time allows for storage to be part of the mix. Using the word allow, like now is formally part of the mix. Previously there was form to be used, but maybe not widely developed like it is today. And therefore, for the foreseeable future, we're going to see a lot of storage in solar and wind in many forms. And still we have to figure out what is the right way to monetize that. And then as we move into higher penetration of renewables, the next barrier is likely to come for hydrogen. So we will see hydrogen in many forms, as a long-term storage, as a means for transportation, particularly for trucks. So there's many ways hydrogen is going to have a significant role, likely to be in the second part of this decade or maybe in the decades to come. But clearly, decisions made today for developers such as ourselves has to take that into account. So our projects takes 2 to 3 years to get developed, and therefore we need to now count on some form of storage. And as we get through that, we'll count on hydrogen. So that's sort of the natural way. Well, first you crawl and then you walk and then you run, and we're in that sort of phase right now. And I hope I answered your questions.
Thank you, Pablo. Miguel Angel, I believe that you have a couple of questions.
Yes, thank you. I have three questions. So first, for Arnaud Ibanez, what makes the difference between you and other potential lender in power project? Yes, basically, in the terms and conditions are quite similar to other commercial banks. What is a difference? I think probably there are three main differences. One, as I explained, most of the team are technical engineers, etc. So I think that we are able to understand a little bit more the technology, the market, etc. And in that sense, I think we are more flexible than other banks, more imaginative about what kind of solution we can create. Some examples I explained. In 2016, we financed the first wind farm with merchant risk, and we did a lot of work about what are the potential risks in that moment in the market, etc., etc. It was a nice project, and that was financed some years ago. Other good example, finance merchant risk with cross collateral with the entire plans. I think that we are the only one bank that we have done that, and that's great. A lot important increase in the leverage. I think another good example of flexibility. Other example of project finance for district heating, project finance for self-consumption, etc. Second difference is the size of the project that we can finance under project finance. As I explained, we are able even to finance project finance with 2 million of debt. I think that we are the only one bank that will do that, at least in Spain. And that's the reason is the mission, as I explained. And third, and probably most important, is the mission of Triodos Bank. When our purpose in the renewable field is to accelerate the energy transition. We really believe in that. It is the main reason for all the workers in Triodos Bank and stakeholders, etc., to be there. Sponsor that finance with Triodos should know that with this money we are promoting all the renewable energy assets that maybe are not financed for other banks, and also we support other sector as the cultural and social sector. Other question is in a country with no sustainable bank, for example, the Republic of Ireland, how can banks be pushed to be more sustainable? Well, first remark is that we are able to finance, at least in the past, in the Republic of Ireland. We did that. The Triodos Bank in UK have done that in the past. As we, as a Triodos, belongs to a global alliance in the banking and values. It's a group of banks around the world to try to push the more sustainable banks, and we have done a lot of things. For example, in the Netherlands, at least, and also in Spain, in the last COP25 in Madrid, we got an agreement with the rest of the banks to publish on a yearly basis what is the carbon footprint of all the portfolio. I think the compromise is to do that in 2 years, and there's another compromise to decrease the CO2 impact of this bank for 2030. So we try to push the banks to be more sustainable, and we collaborate with some of them to do that. And last question around regarding investment in electricity storage. From our perspective, we are really interested in finance and investing in storage. As a matter of fact, we in Triodos has a group of renewable energy expert panel that we have some discussions about how finance different technologies. In July this month, in June and July of this year, we are discussing about finance green hydrogen, and we are discussing with different experts about how to structure that. It's true that nowadays it's a little bit difficult. Probably we need to invest and to finance some kind of public support, because, as you know, the price nowadays is a little bit higher than other technologies, as green and blue hydrogen. But we are really interested And and recently, in fact, we have financed a project about green energy to generate green energy in the Netherlands. And Triodos put money as a bank and as an investment fund. But of course, we should be aware that probably at this stage we probably need some kind of support to finance as a bank. That's all for my side.
Okay, thank you, Miguel Angel. Yes, that's all questions that we have. If you have any other question, you can write us and we will answer by email. Thank you again, Oriol, Pablo, and Miguel Angel for participating in the webinar and for your presentations, and the audience for joining. Have a nice day.
Thank you.
Thank you very much.
Bye-bye.
Bye-bye.